In this section here, we are covering how to build a three-statement model. And when we say three-statement, we mean the P&L, the balance sheet, and the cash flow statement, all connected models so that when you forecast and you reforecast your numbers for the P&L, it's all linked up to the balance sheet and the cash flow statement. And in a sense, you're forecasting cash for the future periods as well. And this is a really good skill if you're a financial analyst or if you're offering fractional CFO services or controller services and you want to provide your clients with a rolling forecast or a budget that has all three statements, P&L, balance sheet, and cash flow statement. Okay, so when we are building a three-statement model, we are going through three steps. The first step is forecasting the P&L. The second step is going to be to forecast the balance sheet. And then the third step is going to be to forecast the cash flow statement. When we are forecasting the balance sheet, we are going to be building schedules for accounts payable, accounts receivable, fixed asset, debt, and various other accounts on the balance sheet. We also are going to be leaving a blank space for cash. So when we are doing the balance sheet, we're going to leave the cash blank. So then when we do step 3, forecasting the cash flow statement, we're going to come up with the cash balance that we then going to plug into the balance sheet. So we'll show you how all of that works. All right, so we said for us to build a three-statement model or a forecast of the three financial statements, we'll begin with the P&L. So what I like to do for simplicity is to layer in on the same tab in Excel, the income statement here on top, and then the balance sheet right here, and then the statement of cash flow right beneath it. So I can pretty much build a forecast that can connect to each other and I can see what I'm doing. I have here the balance sheet. And as you can see, 2025 is blank, right? So my job here is to create the forecast for 2025. In order to do that, as we said at the beginning of the section, we are going to create schedules for accounts payable, accounts receivable, fixed asset, debt, and all of these various accounts that we see on the balance sheet. So let's take a look what that means. So at the bottom of my sheet here, under the balance sheet, I have the cash flow statement. And as you can see, it's still also blank. I haven't done anything there, right? I have here the supporting schedules. So by supporting schedules are going to be resembling the accounts on the balance sheet. So I have accounts receivable, I have accounts payable, prepaid expenses, deferred commission, fixed assets, other accrued expenses, and whatever else I see there that I need to sort of work through and figure out what's going to be the balance throughout the year. So for accounts receivable, let's take that as an example. So what we'll say is for every given month, right, we have a beginning balance for AR, we have billing, right, going on in that month, and then we have collections in that same month. And the ending balance of AR is going to be the beginning balance plus the billing minus the collection. That's going to give us the new balance. So in order for us to come up with these numbers, we need to create a schedule for AP and AR and the various accounts. So I'm going to show you how I built the AR schedule. So if we go here, we have AR and deferred revenue. It's a different tab in this file. When we click on it, you'll see that I built out a customer by customer forecast based on the billing terms, based on the contractual agreement, how much we agreed on. And I built out this schedule that tells me the billing for the various customers. And then the collection for the various customers based on the payment term, 30 days, 45 days, 60 days, whatever you have. So I'm going to be relying on this schedule here, for example, for AR to tell me what's going to be the AR balance. So going back to my file, to my tab here, the beginning balance of accounts receivable is going to be equal. And the beginning balance is always the ending balance of the previous month, right? And then billing, I'm going to link that this tab here to my billing tab. So I'm going to say equal. And I'm going to go to my tab for January 2025, right? And then I'm going to point it to the cell and say enter. And that's going to be my billing for the month. For my collection, I'm going to be doing the same thing. I'm going to point it, I'm going to say equal, and I'm going to point it to the collection, which is I have all the way to the right here of the same file. And I'm going to grab January and collecting $4.6 million. And so my ending balance for January is going to be $13.1 million. And I can then pretty much drag this across all the way to December 2025. And that's going to give me the ending balance for AR until the end of the year. Okay, so that's for AR. Now let's move over to accounts payable. So accounts payable is going to work in a similar way. Accounts payable, the formula is the beginning balance, right? Which is always the ending balance of the last year, plus vendor bills that we expect to receive, minus payments made to vendors is going to be the ending balance. So for AP, I have a similar schedule that you will need to create that has your vendors here, and then the bills that we expect to receive from these vendors, and then the payments all the way on the right here that we expect to make based on the various payment terms to these vendors. So once I've built out my AP schedule, I can link it here and I can say beginning balance and link it to the total vendor bills for January, which is right here. And then payments, I'm going to say equal, and I'm going to point it to the payments as I see the payment total for January of 2025. All right, so now I have an ending balance of $2.1 million for January, and I can also pretty much go ahead and drag this across until the end of the year, and that will give me the ending balance for accounts payable. I'm going to do the same exercise for prepaid expenses. I also have a schedule for that. So for prepaid expenses, beginning balance plus additions minus amortization of these prepaid expenses is going to give me the ending balance. And I have that built out in the AP tab where I have the amounts here, the additional added to prepaid expenses, and then amortization, and I will get to the ending balance. So let's do the same thing right here. So beginning balance equal to the ending balance from previous period. And I can pretty much drag my additions and amortization from the AP tab, and then I will drag that across till the end of the year. And I have my ending balance for prepaid expenses, $5.8 million. And again, this is a forecast, right? So this is not going to be 100% accurate, but this is going to be to the 98, 99% accuracy, whereas this is what I'm forecasting the payments are going to be to vendors in terms of prepaid expenses. If you're enjoying my style of teaching and ready to invest in a comprehensive financial analyst course, be sure to check my FP&A Academy, where I teach you the entire function of the financial analyst over the course of 8 hours. If you're interested, check out the link in the description below. We begin by establishing a 5-year financial plan for the company. Then we draft together the budget for the upcoming year. We then learn about the financial statement analysis using real-life data. We finally discuss the best practices in creating management presentations. If you're interested in joining me in a course, find the link in the description below, head over to the website and check out the detailed curriculum. The next supporting schedule is deferred commission. And this might be something that you encounter at your employer or your client or not. It just depends on if they are complying with the ASC 606 rules for commission recognition. The rules state that if you are paying commission to internal sales employees, and these are commissions paid on incremental sales, meaning that if the contract wasn't signed, there wouldn't be additional or new revenue. When you have an incremental sale like that, then we call that a capitalized commission, meaning that that commission needs to be capitalized. That's why we call it deferred commission, is that we're deferring the recognition of it to a future period. So that's why it's an asset in our balance sheet and it's sitting here. We call it either deferred commission or capitalized commission or prepaid commission, sometimes it's called, meaning it's a capitalized asset. Okay, so for deferred commission, the beginning balance is going to be always my ending balance for the previous period. And I also built out a commission schedule here that pretty much tells me how much new commissions I have each month, and also the amortization of the capitalized commission. As you're amortizing, typically you would amortize these capitalized commission over the life of the customer. So typically you would say, okay, on average, my customer life is 3 years, and therefore I'm going to amortize it over 3 years, or whatever you state to be reasonable. Just document it in a policy and say, hey, this is what I'm doing. I'm amortizing that over 3 years, and that's the average life of my customer. So I'm going to leave this. This is going to be in the file, so you can download it and take a look. But pretty much that will inform the amount of additions and amortization in my file. So I'm going to drag my additions and amortization, and I can also drag that till the end of the year, and that will give me the ending balance in my capitalized commission. All right, next up is going to be fixed asset. Our business here is pretty light on fixed assets. The balance is only about a couple of $100,000. So for fixed assets, you can download a schedule from the accounting system that is being used and see a listing of these fixed assets. So in my case here, my listing of fixed assets is right here, and it has the asset name on the right, and then the month it was added, and the dollar amount for which it was purchased for. And then I have a simple depreciation schedule here that tells me how much is the depreciation for each month. But you can generate this from either NetSuite or QuickBooks. You can get a listing of fixed assets. So my beginning balance is going to be always the ending balance from the prior period. And I'm going to drag these two formulas that are pretty much grabbing my additions and depreciation from my file. I'm going to drag the total, and then I can just drag this across, and that becomes the forecast for my fixed assets. All right, the next schedule that we're going to build out is going to be for other accrued expenses. And depending on the business you're dealing with, your accrued expenses could be accrual for vendor bills. It could be for other expenses that the business needs, such as employee bonuses. In this case here, we have employee bonuses that are attributing to accrued expenses. So I built out a schedule for that here in my commission tab, since this is related to bonuses. And I have a bonus schedule here that shows the amount of bonus that is being accrued, and then the payment schedule, because we are paying these bonuses every year. So I have to accrue for an entire year, and then I go ahead and pay it out at the beginning of the following year. Okay, so that will tell me that the beginning balance is going to be the ending balance of last year. My addition is going to be the new accrual. So I'm going to drag my accrual across, and the payments are going to be made annually. So when you drag this, for example, you're paying pretty much the previous year bonuses. And then I would just drag this across like we've done before, and that would give me the balance through the end of the year. All right, next up is going to be deferred revenue. Deferred revenue is a liability on the balance sheet and represents the obligation to customers because you've collected money in advance, so you record it as a liability. So when you receive that, it's going to be a debit to cash and a credit to deferred revenue. So it's a liability, and the amount of it fluctuates based on what you bill customers versus the revenue that you recognize. And so the simple formula for it is going to be that it's always going to be the beginning balance of it plus the billed amounts, how much you billed customers, minus revenue recorded, and that will give you the ending balance of deferred revenue. So we'll say equal the ending balance of prior period, and then we'll add in the billed amount from our billing schedule that we showed in the AR section, and then we are gonna reduce it by the amount of revenue for that specific month, and that will give us the ending balance for deferred revenue. And we'll just go ahead and drag this across. All right, we're doing great. So let's talk about the last schedule that we have here, which is the debt schedule. So for debt schedule, this is the loan that we have outstanding. There is also a schedule that we need to build for that. And the schedule looks something like this. So this is the debt that we have, $5 million loan outstanding. We took it out at the beginning of 2023, and it has a 7% interest. And the loan goes that for the first year, there's no payments be made on the principal, just the interest payments. And then we have the loan repayment beginning in year 2 and going on for 3 years until the end of the loan in 2026. So once you have this schedule, you can pretty much transpose these numbers horizontally like this, and you can see this done in the schedule. You can download it where you have the loan repayment and then the interest payments. So you can go ahead and link it to our model here. So the beginning balance is going to be always the ending balance from prior period. And then we have additions and we have repayments. There are no additions, they're just repayments. And then we can just drag this across, and that should give us the balance of the loan outstanding at the end of the year, $1.66 million. And that pretty much completes the schedules. And now that we have all these ending balances, we can go up here to the balance sheet and link up to whatever we've done down below. So we've mentioned briefly at the beginning of this section that we will leave cash for now. So we're not doing anything with cash. We're going to leave it aside because the cash balance can only be forecasted using the cash flow statement. So for right now, we'll leave the cash and we'll say AR equals to, and we'll link it to the amount that we got here, $13.1 million. And then for prepaid expenses equal to, and we forecast the prepaid expenses based on our detailed analysis to be $6.7 million. And we pretty much can drag this across. And we will be doing the same thing for all of these accounts here. So I'm going to link up deferred commission equals to, fixed asset equals to, fixed assets from down here for January, right? And I can drag this across. So you see little by little it's coming together. Accounts payable equals to the balance that I forecasted. Accounts payable. Other accrued expenses, I forecasted $760,000. Deferred revenue, that's a liability, and I said that we are going to forecast this to be $11.2 million. Long-term debt equals to 3.1. Drag it across until the end of the year. For the shareholder equity, we have common share, preferred share, additional paid-in capital. For these four accounts here, the common shares and additional paid-in capital, we have no new activity in 2025. So this would only change if you're raising new capital, for example, from equity, but we don't have that. So we will just drag these across because nothing changed in these. The only one that we're going to change is retained earnings. So the definition of retained earnings is the accumulation of net profit or loss in the business, right? You're accumulating and retaining the profits or loss in the business. So it's always going to be equal to the previous period plus the net income or loss from the current period. So for January, it's going to always equal to the ending balance in December, plus we're going to scroll up and go to net profit or loss and add it to that, which is right here, net profit or loss, right? And you can pretty much drag this till the end of the year. And this is saying that we have 37 million retained deficit in the business, right? So it's a negative number, so it's a retained deficit. This business has been historically losing money. And if you see the trend in retained earnings is that the negative amount has been getting better and becoming a smaller negative number, which means that we are beginning to generate some profits. And hopefully in the near future, we'll go from retained deficit to retained earnings in the business as it becomes a positive number. Okay, so now we have the balance sheet except for the cash. All right, so now we're down to step number 3 in creating the 3-statement model, which is the cash flow statement for the next year. Okay, so like we've said, we've created the P&L forecasts. in prior lectures. And then just now we just did the balance sheet forecasts, but we didn't forecast cash because cash we said is going to come from the cash flow statement. So what we're going to go ahead and do now is create a forecast for the cash flow statement, and that's going to inform our cash balance going forward. It is important to note, however, that when we are talking about the cash flow statement, step 3, we are talking about the indirect method. So there are two methods, as you can see on the screen, direct and indirect. The direct method of the cash flow statement takes, it's very simple, cash from customers, cash payment to suppliers. So it takes pretty much inflows and outflows, and it's pretty straightforward and easy to understand. What we're using here is the indirect. The indirect method is the one that can be modeled into a 3-statement model, right? So this one takes net income and then adjusts for non-cash expenses like depreciation, amortization, changes in the various balance sheet accounts, and arrives at cash from operations, and then adds in cash from investing and financing activities. So that's the method of cash flow statement that we are using in this forecast. So this is going to be the structure of this section. So when you look at the cash flow statement, as we had mentioned, this is an indirect method of the cash flow statement that begins with net income and then adds in non-cash items such as depreciation and then the changes in the various current assets and current liabilities to come up with the cash from operating activity. And then it looks at other investing activities such as buying or investing in equipment. And then it looks at financing, which comes from either equity financing or debt financing to come up with the cash coming in from financing, and then adds the three together to say, here is the increase or decrease in our cash balances. So the first step in creating the forecast is net income. We know net income, so we're going to say equals to, and we're going to link it to net income or loss that we have here for January. Hit enter. And then the next item is going to be depreciation. So if you have non-cash item, amortization, depreciation, you add it here. So you say, okay, this is equal to the depreciation amount, which you'll find on the income statement above for January, right here. And that will give you the depreciation amount. Now, for the changes in the current assets and liabilities, this one is a little confusing to some people, whether the sign is negative or positive, but I'm going to show you hopefully an easy way to remember how to do the sign. So for accounts receivable, it's going to be the difference between the current period, which is January, and December. It's just that the sign is what you need to figure out. So we're going to say equal to, right? And when you look at the change in accounts receivable between December and January, look at the accounts receivable balance. It went from 7.7 million to 13 million. So it went up, right? And the way that I determine the sign usually is to ask the question, is this change good or bad for cash? Not good or bad for the business. I don't care about that right now. I care about, is it good or bad for cash, right? So is accounts receivable going from 7 million to 30 million, increasing that much? Is that good or bad for cash? A buildup in accounts receivable. It's bad for cash because you're building up accounts receivable to $13 million, which means that this sign here is going to be negative, right? So to make it negative, I would need to say equals the smaller number minus the bigger one. And that's going to give me negative $5.4 million. This is saying that my accounts receivable balance went up from 7 million to 13 million. It went up dramatically, right? Which means that I'm not collecting cash. So this is the part that is a little confusing to some people, is for the changes in current assets and liabilities, whether it's a negative or positive change, is always depends on the question, is this good or bad for cash? Here in AR, build up in AR, bad for cash, negative. Okay, prepaid expenses, same thing, same trick. So we're going to say equal to, and we go and examine prepaid expenses. Prepaid expenses changed from 5.8 million to 6.7 million, right? That is a prepaid that's going up in value, right? Almost $1 million going up in value. Prepaid going up in value. Think through it, right? So when a prepaid is going up in value, it means that we prepaid some more, right? Is that good or bad for cash? Bad for cash. You guessed it, right? Because we're prepaying. The prepayment is going more. If the prepaid amount is getting less over time, that means that you're not paying actually, right? That's a positive thing. But here, the prepayment is going up. Is that good or bad for cash? Bad for cash, right? So negative. Okay, so that's going to be this number, the smaller number minus the bigger number to give us a negative amount, negative 875. All right, let's try one more. Deferred commission, and we said deferred commission is capitalized commission. To determine if it's positive or negative, we're going to examine and say equal to, and go up to capitalized or deferred commission on the balance sheet and have a look at that. We're seeing it going from 11 million to 11.1. So it went up slightly, right? So it's a capitalized asset. Commission is a capitalized asset. It means that you paid some more commission and you capitalized it, right? So you got to think through it. You paid some more commission and you capitalized it. That's why the balance went up. Is that positive or negative for cash? It's bad for cash, right? You paid more, right? So it's going to be the smaller amount minus the bigger amount, negative 93,000. Let's do accounts payable. That's a very great example also. We're going to say equal to and look up at accounts payable. And we see that accounts payable went from 2.1 to 2.131. It's a very slight change, but it went up slightly. Right? When accounts payable, which is a liability, is building up, right? Building up. Is that good or bad for cash? Actually, that's good for cash, right? Accounts payable balance is building up, right? That's a good thing because you're able to conserve your cash, right? So that's going to be positive. So I'm going to take the bigger number minus the smaller number. Okay, that's $8,000 increase. Not a whole lot, small amount. Okay, accrued expenses. That's another one. So we'll say equal. Let's look at other accrued expenses. The balance went from 3.2 million to 760,000. Okay, take a second to think through that. The balance of an accrued expense was big and suddenly went down, right? This is how I like to think of it in my head too, dramatically like that. It was big and all of a sudden it shrunk. So what happened, right? It was an accrued liability that we paid, right? So because we paid it, that means it's bad for cash. All right, so it's going to be a negative number. It's going to be the smaller one minus the big number. That's going to be negative $2.4 million. The next one is deferred revenue, and we said deferred revenue is a liability that is saying that we are collecting more cash from customers than we are recognizing as revenue. So it's a liability, right? So let's see the logic and how to put the signal for that. So equal to deferred revenue. The balance went from 8 million or 8.8 to 11 million, right? So deferred revenue going up, what does that mean in terms of real life? What's happening? When deferred revenue is going up, it just means that we are getting more from customers than we are recognizing as revenue, right? So this is cash coming in. That's a positive number. So it's going to be equal to the bigger number minus the smaller figure. And that's going to be a positive $2.3 million. Okay, so for this section here, for operating activity, I am pretty much done with these numbers, and I can go ahead and drag it across to the end of the year, and that will pretty much model for me the cash coming in from operating activity. All right, the next section is going to be property, plant, and equipment, or investing activity. And that's going to be just the amount that I'm investing in new equipment. So I'm going to say equal to. And remember, we built a fixed asset schedule at the bottom that has our additions right here, which is right here, fixed assets, right? So I can pretty much grab this number, 2,000, link it up here. I'm just going to make it negative because this is a cash going out, right? And pretty much drag this across. That's the only item that I can identify on my activities that is going to be investing in new equipment. Now, for financing activity, we're not really issuing any equity, but we have debt that we are repaying, right? So the amount that we have right here is 138,000, and I can see that in the fixed in the debt schedule at the bottom. I have here repayments of 138. So that stays constant throughout the year. So I'm just going to link it up to here and say these balances are really zeros. There is no activity in here for taking on new short-term debt or long-term debt. So I'm just going to say equal and link it to the 138,000 at the bottom. And again, I have no convertible debt or new preferred equity or common equity, so that's going to be 0 unless you have this activity. Then if you do, you need to build out a schedule like how I showed you. So now let's go ahead and drag this till the end of the year, right? And that's going to give us here the financing activity section is complete. Now, we have net change in cash on a monthly basis right here, which is really just adding up the 3 sections together: the operating, the investing, and the financing, right? And then we are saying, okay, the beginning cash balance is going to always be the ending balance of the previous period. So equal to the ending balance in the previous period, and I can drag this across here, right? And that's gonna complete my statement, because then it's gonna say, okay, ending cash is gonna be really just the beginning cash plus the net change based on the 3 sections above, right? And that tells me that the ending cash balance for February is $19.7 million. As you can see here, I have a check. So I have here a check that says check the cash flow statement against the balance sheet for cash, and it's showing a difference, and that's because we haven't yet plugged in this ending cash up in the balance sheet. So we'll go ahead and plug it in. So in the balance sheet, we left the cash section blank, and now we can go ahead and populate that by saying equal to and pointing to the ending balance right here, right? And then dragging this across till the end of the year, right? And that's going to give us a complete balance sheet and a cash flow statement. And now, as you can see, my check here at the bottom that says check the cash flow statement against the balance sheet, obviously that's going to be zeros because now it's linked together. And the nice thing about having this build up done together is that you can now change anything in the income statement, and that's going to change cash. So for example, cash at the end of next year or 2025 is $36 million. But I can go and play around if I reforecast my revenue and say, hey, you know, my revenue is going to be a little bit more. So an extra $3 million, right? So that's going to increase my revenue for the year, the forecast from 180 million to 121 million, right? That's going to change cash also, right? From 36 million to 39 million. Right, so you can see this is already built or linked together. So as your business assumption change and you get closer and closer to the end of the year, you can reforecast these numbers, and that's going to change the balance sheet amounts and also the cash position amount and the cash flow statement. So now we have a rolling monthly forecast of the P&L. Also with the annual amount. So we have a column here that gathered the annual amount for the P&L, and the balance sheet, also the ending balances for both years, and it's all linked together in one model. Go ahead and download it from the lecture. You can find this Excel file, kick the tire and just play around and see where these numbers are coming from and get comfortable with this type of analysis, because it's super crucial for any CFO, financial analyst, manager of FP&A, any of these roles.